You have almost certainly passed by them without a second thought. Those unassuming storefronts tucked into suburban strip malls and urban commercial corridors, their windows papered with fading photographs of elegantly manicured hands and their interiors humming with the low, constant sound of electric files and the murmur of conversations in languages you do not recognize. The nail salon is, for the vast majority of Americans, a site of affordable self-care and feminine ritual. A place where one goes to be polished and buffed and sent back into the world with a small but satisfying increment of beauty and order. But beneath the surface of acetone and cuticle oil, beneath the transactional exchange of cash for service that appears, from the customer's perspective, to be a perfectly ordinary and fully accounted for piece of the formal economy, there operates a second, parallel economy, an intricate and largely invisible system of rotating credit, pooled capital, and trust-based lending that has enabled generations of immigrant entrepreneurs to bypass the gatekeepers of the traditional financial system and to build, from the ground up and often in a single generation, a foundation of economic stability and upward mobility that the formal economy, with its credit scores and its loan applications and its insistence on documented histories, would have denied them entirely. This is the nail salon economy, and while it is most visible in the thousands of storefronts that dot the American landscape, it is merely one manifestation of a much larger and more ancient phenomenon, a global archipelago of informal financial networks that operate in the shadows of the formal banking system and that constitute, in the aggregate, one of the largest and least understood pools of liquidity in the world. To understand how these networks function and to appreciate the sophisticated financial psychology that underpins them is to see the American economy through a different lens entirely, a lens that reveals the hidden currents of capital and trust that flow beneath the surface of the official statistics, and that power, a significant portion of the small business formation and immigrant wealth creation that the formal system claims as its own. The core mechanism that animates the nail salon economy and the countless other immigrant microeconomies that operate on similar principles is a financial instrument that predates modern banking by centuries and that goes by many names in many cultures: the Rotating Savings and Credit Association, or ROSCA. In the Vietnamese community, which dominates the nail salon industry in the United States to a degree that is difficult to overstate, this instrument is called a hui or ho, and it functions with an elegant simplicity that belies its profound economic power. A group of individuals, typically numbering between 10 and 30, agrees to contribute a fixed sum of money to a common pool at regular intervals, usually monthly. At each meeting, the total pool is awarded to one member of the group, either through a bidding process in which members offer to accept a discounted payout in exchange for earlier access to the funds, or through a lottery, or through a predetermined rotation that ensures each member receives the pool exactly once over the life of the cycle. The member who receives the pool is then obligated to continue making their fixed contributions for the remainder of the cycle, and the cycle concludes when every member has received the pool once, at which point the group may dissolve or, as is more common, immediately begin a new cycle. The mathematics of this arrangement are straightforward. A group of 20 members, each contributing $1,000 per month, generates a monthly pool of $20,000, and over the course of a 20-month cycle, each member will have contributed $20,000 and received $20,000, less any discounts that were accepted in the bidding process. There is no interest paid or received in the traditional sense, and there is no formal contract that could be enforced in a court of law, only the shared understanding that failure to meet one's obligations to the hui will result in the complete and permanent loss of one's standing within the community, a penalty that is, for the participants, far more severe and far more motivating than any late fee or collection notice that a bank could ever impose. The psychological explanation for why these informal arrangements work with such remarkable reliability and why they have persisted for centuries across cultures and continents while formal financial innovations have come and gone, lies in the profound difference between the incentive structures of a trust-based community and the incentive structures of an anonymous market. When a borrower applies for a loan from a bank, the bank evaluates the borrower's creditworthiness using a set of standardized metrics that are designed to be objective and impersonal: income, assets, debt, to income ratio, and the borrower's history of repaying previous obligations as recorded by the credit bureaus. This system has many virtues, not least of which is its scalability and its ability to extend credit to strangers. But it also has a fundamental limitation, which is that it cannot access the rich, textured, and constantly updated information about a person's character and reliability that is available to the members of a tight-knit community. The participants in a HUI do not need a credit score to evaluate the trustworthiness of their fellow members because they have access to something far more valuable: the accumulated knowledge of a shared social world in which reputation is earned and lost over years and decades, and in which the consequences of a breach of trust extend far beyond the financial realm to encompass every dimension of social and familial life. A person who defaults on a bank loan may suffer damage to their credit score and may receive unpleasant calls from a collection agency. But a person who defaults on a HUI obligation suffers a fate that is, from the perspective of the community, far more devastating. They become a person who cannot be trusted, a person whose word has no value, a person who has violated the fundamental compact upon which the entire social and economic life of the community rests. This is a penalty that no bank can impose and that no court can enforce. But it is enforced nonetheless, with an effectiveness that the formal financial system, with all of its legal machinery and its armies of compliance officers, can only envy. The mathematical breakdown of the nail salon economy, when examined at the level of an individual entrepreneur, reveals a pattern of capital formation that is both remarkable in its efficiency and entirely invisible to the official economic statistics that shape our understanding of how wealth is created and distributed in this country. Consider a Vietnamese immigrant who arrives in the United States with limited English proficiency, no credit history, and a modest amount of savings accumulated from years of work in her home country or from the pooled resources of her extended family. She finds work as a nail technician in an established salon, earning an income that is paid largely in cash tips, and that is, from the perspective of the formal banking system, difficult to document and therefore difficult to leverage into a business loan. She joins a HUI with other technicians and with friends and relatives from her community, contributing a portion of her earnings each month to the rotating pool. When her turn to receive the pool arrives, she takes the accumulated capital, which might be $20,000 or $30,000 or $40,000, and she uses it to lease a small commercial space, to purchase the equipment and supplies necessary to open her own salon, and to cover the first few months of operating expenses while her client base is being established. The salon opens, and it generates income, and she continues to participate in HUIs, sometimes as a contributor and sometimes as an organizer, using the rotating pools of capital to expand her business, to hire additional technicians, to open a second location, and to finance the educations of her children and the purchase of a home. All of this economic activity is real, and it generates real wealth and real tax revenue and real improvements in the material circumstances of the people involved. But a significant portion of the capital that fueled it never appeared on a bank balance sheet, was never approved by a loan officer, and was never recorded in any of the databases that economists and policymakers use to understand the flow of credit in the American economy. The nail salon economy is, in this sense, a vast and largely invisible liquidity pool, a parallel financial system that operates alongside the formal system, and that provides a crucial bridge from the cash economy of immigrant labor to the asset economy of small business ownership and middle-class stability. The systemic zoom-out reveals that the nail salon economy is not an isolated curiosity, but rather one instance of a global phenomenon that has profound implications for how we understand economic development, financial inclusion, and the relationship between formal and informal institutions. The World Bank and other international development organizations have long recognized the importance of ROSCAs and similar informal financial arrangements in economies where access to formal banking is limited, and they have devoted considerable resources to studying how these arrangements function and how they might be integrated with or supplemented by formal financial services. But the presence of these arrangements in the heart of the world's most sophisticated financial system, in the strip malls of suburban America, rather than in the villages of the developing world, suggests that their persistence is not merely a function of inadequate access to formal banking, but rather a reflection of something deeper and more enduring about the nature of trust, community, and capital. The formal financial system, for all of its efficiency and scale, is ultimately a system for allocating capital among strangers, and it relies upon a vast and expensive apparatus of credit reporting, contract enforcement, and regulatory oversight to make that allocation possible. The informal financial system of the Hui and its global counterparts is a system for allocating capital among people who are not strangers, who are bound together by ties of kinship, ethnicity, and shared experience, and who can therefore dispense with much of the expensive apparatus that the formal system requires. The result is a system that is in some ways more efficient than the formal system, with lower transaction costs, faster decision-making, and a flexibility that allows it to serve borrowers and savers who would be rejected or ignored by the formal system. But it is also a system that is inherently limited in scale, that cannot easily cross the boundaries of the communities in which it is embedded, and that is vulnerable to the same human frailties and conflicts that complicate all human relationships. The identity shift that this analysis invites is not one that can be easily adopted by an outsider, because the nail salon economy and the countless other informal financial networks that operate in immigrant communities are not products that can be consumed or strategies that can be imitated by those who lack the social capital and the community standing that give them their power. The Hui works because the participants share a history and a culture and a set of mutual obligations that cannot be replicated by simply gathering a group of acquaintances and agreeing to pool money each month. And any attempt by an outsider to appropriate the form without the underlying substance of community trust would almost certainly end in failure and acrimony. But the identity shift that is available to the outsider, to the customer who sits in the pedicure chair and scrolls through her phone, while a technician whose name she may not know and whose story she is never asked to hear, tends to her feet, is a shift toward a more accurate and more respectful understanding of the economic activity that is occurring all around her. The nail salon is not merely a place where a service is rendered in exchange for payment. It is a node in a vast and sophisticated financial network, a site where capital is being accumulated and deployed, where businesses are being born and grown, and where the economic aspirations of an entire community are being realized through mechanisms that are invisible to the formal economy, but no less real for their invisibility. The shift is from seeing the nail salon as a place of low-cost pampering to seeing it as a place of genuine economic significance, a place where the quiet, unglamorous work of immigrant wealth creation is being performed every day, behind the frosted glass and beneath the hum of the electric files. The calm closing of this inquiry is not a call to action or a prescription for policy change, because the nail salon economy is, by its very nature, resistant to the interventions of outsiders and is likely to persist in its current form, regardless of what policymakers or academics or curious observers might think about it. The calm closing is, instead, an invitation to sit with the recognition that the economy we think we understand, the economy of GDP reports and payroll statistics and bank lending surveys, is only a partial and incomplete representation of the economic reality that surrounds us, and that beneath the surface of every transaction that appears to be fully accounted for, there are currents of capital and trust and community that operate according to their own logic and their own rules. The nail salon economy is one such current. And it has carried tens of thousands of immigrant families from the margins of the American economy to its solid and prosperous middle, without fanfare, without recognition, and without any of the formal institutions that we have been taught to believe are essential to the functioning of a modern financial system. The next time you pass a nail salon, or a dry cleaner, or a corner grocery, or any of the other unassuming storefronts that house the invisible economies of immigrant America, you might pause for a moment and consider the possibility that what you are seeing is not merely a small business, but a portal into an alternative financial universe, one that operates in the shadows of our own and that has much to teach us about the true nature of capital, trust, and the human capacity for economic cooperation.